Okay, so they're going to turn around and debit sales tax payable and credit cash. And I'm not showing that journal entry here, but it's there. Okay, the next one we're going to look at is payroll and payroll taxes payable. You could be paid a salary or you could be paid a wage. If you're paid a salary, it's an annual rate of whatever, 12,000, 20,000, 30,000, 50,000, 100,000 a year. If you're paid a wage, it's an hourly wage. We do three things when we figure the payroll. Now, we're always looking at the point of view from the company in accounting. Even though all of us get a paycheck, when we do the journal entries, it's from the point of view of the company. So we have gross earnings, we have payroll deductions, and we have net pay. And as employees, we call it take-home pay. Okay, so a company pays its employees, but in fact, they only pay you the net pay, but you earned the gross pay. And so at the end of the year, what happens? You look at, they issue you something of a report called a W-2, and you get that and you file your tax return based on the information in the W-2, and you have to report gross wages unless there's some tax exempt items in there. And so what the company does throughout the year is they collect taxes from you, and then they turn around and pay them to the government during the year, not at the end of the year. And then you figure, and that's just an estimate of what your taxes are owed. When you go at the end of the year and you actually fill out your tax return, you'll compare it to what was paid in, and you'll either get a refund or you'll have to pay. And by the way, if you have to pay, the government, if you have to pay a lot, the government will be anxious that you will pay more often. They don't like it when you owe them at the end of the year. All right, so let's look at the journal entries. So in this example, the company owes its employees $100,000, but they're only going to pay $67,564. So please turn to your course pack and you can follow along in this journal entry. If you haven't printed your course pack out yet, please do so now. Pause the video and come back to this. Thanks. Okay, so just a reminder, same with sales tax. The corporation must pay the difference to various authorities. The corporation does not keep the difference between the $100,000 and the $67,000. They have to turn right around and issue checks to the IRS, to Social Security. If you are part of a union and your union dues are deducted from your paycheck, they have to pay those. If you pay part of your insurance premium, they have to turn that over to Blue Cross or Blue Shield, whoever the insurance company is. But let's be real clear here. Companies must pay your payroll taxes promptly, and they must pay them. If they don't, the IRS will prosecute the company. They will go after the company. If it's a small business, they will impound things in your business. If you have a spouse who's working at another company, they will go after your spouse's paycheck. It can get really ugly. So if you're a small business owner, you have to make sure to transfer those funds over right away. If you're really small, you don't have to do it as often as big companies. You can only have to do it quarterly. But big companies like Paquette and Boeing, they have to do it within a day, or they have to pay the payroll taxes within a day or two of issuing paychecks. Okay, so let's look at the payroll for this company. This company had the paychecks that were paid out. We don't know how many employees are here. I think we said 5,000 hours, so it's quite a few employees. Net pay of 67,000, gross pay 100. So what are the deductions here? We've got FICA, something called FIT, and SIT. So FICA is your Social Security and Medicare. Federal income tax is an estimate based on your W-4 when you go work for a company. $21,864, and state income tax. Now, Washington State doesn't have an income tax, so this would be for another state. So they withheld $32,436 from your paycheck, not your paycheck, all the employees' paychecks. And the employees are all going to go to the bank on Friday or whenever they're paid, and all of those paychecks add up to $67,564. So we have to book it. Now what I'm going to show is the company's journal entries. So first thing, they have to record the payroll. So they are going to record salary and wage expense. And if a company wanted, they could have two accounts, salary expense and wage expense. We just combined them here. So again, we've recognized an expense of $100,000, and that'll lower profit $100,000. And then all of those other items are going to be payables because they haven't been paid out at the point when they booked the payroll entry. FICA payable, federal income tax payable, state income tax payable. And that last item, salaries and wages payable, $67,564, that is there because the employees have been handed a check, but they haven't cashed the check yet. When they cash it, that entry will be reversed. And here they go. They all run to the bank and they cash their checks. And when that happens, the company will make a journal entry to clear out that payable and reduce cash. And there's usually a timing difference, and you'll always have an employee who doesn't cash his check right away. Okay, so here's the deal. There are additional taxes that the employer has to pay. Now let's go back to that previous slide. The only expense we recognize is the gross amount, $100,000. These deductions are coming out of the employee's paycheck. So the employee has paid for Social Security and Medicare, and you see that on your own paycheck, federal income tax and state income tax. That's coming out of the employee's paycheck. Okay. However, the employer has to match the FICA tax, also called Social Security. So they're going to pay an additional amount. The employee pays half, the employer pays half. Okay. In addition, they have to pay two additional taxes, federal unemployment and state unemployment. And those are the rates there, 0.008%, 0.054%. Okay, so we already had that first journal entry. Now we have a second journal entry for the additional taxes that the employer is paying, $13,850. And the FICA tax payable, yes, it's the exact same amount that we saw on that other journal entry because the first one was the employer paying. The first one was the employee paying, and the second one is the employer paying. And then these additional taxes, unemployment. Okay, last one here, unearned revenue. Unearned revenue is money that the company receives in advance. So it's basically advance payments before the company provides goods or services. So it'd be like a down payment where you're making a down payment but you haven't received anything yet. It is the company is not allowed to call it revenue. What's the rule for calling it revenue? The service has to be performed. And if it's an advance payment, the service hasn't been performed yet. If it's a down payment, the product has not been delivered yet. So the rule is you can't call it revenue, which would be a revenue account and would be shown on the income statement. Unearned revenue is a liability because we owe them service. We owe them product. So when we receive that when the company receives that advance payment, it increases cash and it credits a current liability. Later on, when the service is provided, it clears out the unearned revenue and credits a revenue account. So what are things that would be unearned revenue? Season tickets always sold in advance, airline tickets sold in advance, magazine subscriptions sold, insurance coverage sold, and that would be by an insurance company, advance payment on vacation, any advance payment for merchandise. Okay, let's assume the Seattle Mariners sell 100 season baseball tickets at $1,782 each. Outfield reserve is a particular seat in the stadium, location in the stadium. And this $1,782 covers 81 home games. All right, so first thing they do is they want to recognize the sale of 100 tickets of those particular outfield reserve tickets. So they're going to recognize the cash and they're going to book it to unearned revenue. At the end of the first month of games, April, the Mariners plays has played 13 home games, and it would record the revenue earned on those 13 games. Now, it's not all the games, it's just 13. So again, we'll just prorate that, and we're going to debit unearned revenue to clear out 13 of those games, and we're going to recognize ticket revenue. And that's, you don't have to call it ticket revenue. You could call it service revenue. Companies often like to be more particular in their titles. Either one is acceptable to me. So the calculation is shown below. We're going to divide up that 178,200 over 81 games and then apply it to 13 games. Okay, so here's a T account. So we put 178,200 into unearned revenue with that first journal entry. After the end of April, we took out 28,600, leaving the balance of 149,600. And that should, you can always test the balance in unearned revenue and make sure it adds up. So we're going to test it. We're going to say that should be 2,200 times 68, and it is. Okay, if you have long-term debt that comes due in the current year, I mean, it does come due eventually, that would be categorized as current liability. Okay. Last thing for part 1 is the calculation of working capital and current ratio. So we like to know what the difference is between our current assets and current liabilities. That's called working capital, and that's our ability to meet short-term obligations. We like that number to be positive. Obviously, if current liabilities are greater than current assets, that is certainly a warning sign. And then with current ratio, that's a ratio, so we divide current assets by current liabilities. And again, if those numbers were, we want that number to be greater than 1 because that means current assets are greater than current liabilities, and the higher the better. All right, that concludes section 1, and then you can go on to the following sections. And again, if you want to re-listen to this, you can tab from the table of contents allows you to tab out of this.